Thanks for tuning in to BloombergQuint, and we are in conversation with Mark Matthews of Bank Julius Baer to talk about all that's happened in the globe in the last, well, 24 odd hours, 2 or 3 events. Mark, the most prominent, good morning of course, and thanks so much for joining in. The most prominent among them is what a lot of people feared could turn out, which is, as of now, as we see it, no clear majority to either of the parties in the UK elections. If this is how it continues and it eventually reaches a stalemate position, what does this do to financial markets, if anything?
Frankly, I don't think the UK is a large enough economy to provide contagion to the rest of the world. So what I think it means is that clearly Theresa May miscalculated, just as her predecessor David Cameron miscalculated in calling for a snap election where in his case, he thought he would get a resounding mandate in favor of remaining in the EU. In her case, she thought she would increase her seats in Parliament. And as you rightly say, the opposite has happened. So she has more seats than any other party, but not enough to form a government. And she'll have to seek the help of one of the smaller parties. I'm not sure that really it has such a big impact. But what it should mean net is a weaker than expected government in the United Kingdom, and therefore perhaps weaker when it comes to negotiating with the EU. And therefore the pound really should not go up, and it probably should go down. Now, the irony is that the UK is one of the countries where there's an inverse correlation between their currency and their stock market. In other words, when the pound goes down, historically, the FTSE, the Financial Times Index, has actually gone up. And that happened after Brexit. It'll happen this time too. So ironically, for investors into shares, a weaker pound means higher profits from the companies listed in London, because most of them are these big multinationals like Shell or Reckitt Benckiser, and their profits go up as the pound softens.
Well, that's an interesting correlation. I must tell you, Mark, a bunch of Indians, when they hear a weaker pound, they are very happy because a lot of Indians travel to UK quite regularly. But my question is, there is about a 15% depreciation, I think, that the pound already has had vis-a-vis the dollar, if I'm not wrong. Give or take a few points here and there. You think another 5–10% is in the offing?
I have to say yes. I previously thought that 1.2 was a very good bottom in the pound, and I now question that. Of course, we're still a little bit away from that now, but I think that you also have to look at the other side of the coin, which is that there are good reasons for both the euro and the dollar going up, and better reasons for them going up than the pound going up. So if you just put those together, the other side of the coin, then the pound should go down.
Okay. Any surprises that the commie testimony threw up? I mean, I thought when I was hearing that he said more of the same, more that I anticipated. Yes, it was hurting Trump in many ways, but we didn't expect anything otherwise. Does it cause any disruption, you think?
Well, he pre-released his testimony the day before. And so we already knew what he was going to say. He did say that Trump was not under investigation and that he did not collude with the Russians. So, he made plenty of negative comments, but he did not outright accuse Trump of, what do they call that? Interfering with justice. Obstruction of justice. So on balance, actually, it was less damaging than people thought it was going to be.
So therefore, no major disruptions, in which case I come to emerging markets in India. For an emerging market investor, do any of the last 3 events, the ECB pretty much playing par for the course, commie not too disruptive, and the UK election verdict as well, which you rightly said probably doesn't have too much of an impact on the global economy and therefore on the global markets. If you are an EM investor, if you are an India investor, does anything change in the last 24 hours?
Nothing has changed, no.
I believe you were bullish on India. If I read your earlier interviews that I read online, you had mentioned maybe a couple of months back or 3 months back that you believe that it's easy for the Nifty to scale 10,000 in the current financial year. We are almost on the cusp of that. Do you believe that we could overshoot those targets coupled with earnings growth and the reforms momentum that we've now taken in India?
I think so. I think that there are basically a lot of positive forces in the market right now. One force is that there's a lot of money coming into the market from locals through the SIP funds, and that is a very strong and steady flow. Foreigners have been buyers of India, I think, to the tune of about $7.5 billion over the last 12 months. But there's ample room for more. If you look back, there were several other periods of time where foreigners put in over $20 to $25 billion into the Indian market in a 12-month period. So what they've put in so far, I think, is really only halfway. But they've clearly been preoccupied more with Taiwan and Korea this year, the technology-related markets, because what's led in the United States as well, obviously the NASDAQ and Amazon and Facebook and things like that. But no, I think India is still good. The fourth quarter results were, the profits were in line with the consensus, but what interested me was the sales, if you exclude the banks, for corporate India were up 15% year on year, and that was the strongest in 4 years. So I feel like the cycle is positive for the economy, and the RBI is being accommodative. And I noticed yesterday that they loosened some of the rules and regulations on the weight that banks need to set aside for mortgage loans, and they cut provisions on home loans. So I feel like it's still a good place to invest, and nothing has changed.
But the only question is, if I look at the last 1 year performance, Asia Pac, probably all economies or all markets have given even Stevens 15, 17, 18, 20% returns. Not much to choose between them. But if I look at YTD, India has outperformed, maybe a couple of other markets have, but India largely has outperformed the Asia Pacific region. What's the quantum of upside that you see in the Indian markets over the next 1 year? I mean, there could be some disruption in between, but overall, point to point, do you believe there is a room for another 10% upside for Indian markets?
I do, because if you look back at the emerging market asset class as a whole, it's still below its previous high of 10 years ago, whereas the S&P broke above its 2007 high in 2012, and today, I don't know the number off the top of my head, but I would say the S&P is easily 25% higher than where it was in 2012. So we have some catching up to do in the emerging markets. Basically, emerging markets were big underperformers from 2011 until the end of last year, and that trend has changed, but we're only 6 months into the trend change. When you think that the developed markets outperformed the emerging markets for the last 5-6 years, and now we are only 6 months into emerging markets outperforming developed markets, then I think the trend can continue.
Last question, Mark. Any possible disruptions that you foresee to fund flows into countries like India? FI?
There's always, the black swans, and by nature they cannot be predicted. I don't see any reason to be concerned on the horizon. And when you look at all the bad news that's come out of Washington this year, and that yet the market has been able to absorb that, and the bombings that have happened in Europe, and the market has been able to absorb that, this is a bull market. I see it continuing at least to the end of this year. We could question the market next year because in America there are some signals that it is becoming overbought. But I think that's still, 6 months away. The thing that would concern me, I suppose, for India is that if for some reason the dollar started to strengthen suddenly, and the irony is that all this noise in Washington with Donald Trump and Russia and James Comey is keeping the dollar weak. But that's good for emerging markets, because why emerging markets don't like when the dollar is strong is that foreign investors don't want to lose money in the currency when they buy a place like India. So, they'd say, well, I'd like to buy Indian stocks, but I don't want to lose money in the currency. So if we're in this nice environment now where the dollar's not very strong, it actually attracts more fund flows to places like India. Broadly, I see that continuing for the foreseeable future.
Great. Mark Matthews, appreciate you taking the time out. Have a great weekend. Thanks for joining us on BloombergQuint.